Welcome to another presentation from SR Snodgrass as part of the ongoing podcast series. Today, I'm speaking with Ian McDowell, an Audit and Assurance Principal. Welcome back to the podcast, Ian.
Thank you, Lenore. Thanks for having me back.
Great to have you back. I know today we're speaking about something that's more technical and more complex in nature, and that is segment reporting. So why are we talking about segment reporting today?
So the reality is, as an audit firm, we want to not just audit our clients' financial statements, but we want to help them understand and implement new accounting pronouncements that the FASB releases. There is a host of activity that comes from the FASB every year, and so it's useful to have someone kind of go through that, filter it, and kind of condense it down into useful, easy to digest topics that they can then take back and use as kind of the starting point to do their own internal analysis and build their documentation around the implementation. So that's what we're trying to do with this accounting topic. Okay. Now, the question comes about, why is FASB releasing information on segment reporting?
Because segment reporting's not new.
That's right. In fact, if you go back, the original segment reporting standard was released in 1997. So the SEC really likes the segment reporting topic because, unlike other standards that are out there, it's framed more from the perspective of what is management doing internally at the organization to measure and monitor financial results. When you think about all of the other standards that are out there, almost all of them, they're designed, they're very checklist based, and everyone discloses the same information. This is a topic where you're almost left to your own devices to identify the way that you process information internally as a company and then report that to the public. And it's very likely that your information is not going to look like the information of another filer. So that provides its own set of challenges. So what I'm trying to do here today is take a topic that's fairly expansive with a lot of detail and boil it down to some actionable items that you can then take back into your organization and run through and review as a starting point to evaluate the changes that you're going to have to implement this year.
So with that in mind then, it sounds like the timing of it is because year-end, doing those financial statements, now's the time that it's really important for any company I guess also is the question, to start paying attention to this. So let's start with that. So any company, who's affected by this?
Right, yep, let's get right into that. Okay, so we'll kind of start at the end, right, which is the effective date. So the FASB breaks down most of their new standards into two buckets. One is it effective for public business entities, and is it effective for non-public business entities? This standard is a little unique in that it's effective for public business entities only, with an optional, there's always an option for a non-public entity to incorporate these disclosures. But as a starting point, any company out there needs to be aware that a public business entity is not just one that files with the SEC. There can be other non-filers that also meet that definition. So as a first step, if you don't know if you are a public business entity or not, go out and do that evaluation first. But that's a separate podcast. So once you've made the determination about whether you're a public business entity or not, then you look at the financial reporting period. And this particular standard is effective for any entity whose financial reporting period begins after December 15th, 2023. For most companies that are calendar year based, that's going to mean this is going to be the first year that you're going to have to implement these new rules.
Gotcha. That makes a lot of sense. I guess one other question too, while we're talking about that time frame, transition periods. Is it affecting, last year's audit at all? How is it getting worked into the disclosures too at that point?
Yep. So there are two types of transitions that are commonly used in standards. This happens to be a retrospective application, which means if you determine that changes are effective for the current year, then you've got to go back and make those same changes, if it's feasible, for the prior year so that the presentation is comparable. And that could be a big lift for a lot of companies. Just gathering the information, making sure you've preserved it in the right format to be able to go back and do the analysis in the prior year is something that a lot of companies are going to have to think about.
Okay, that makes sense. So thanks for helping explain that a little bit in greater detail. So let's start talking about the actual accounting standards update then. What are some of the initial changes that we should hit upon here?
So we're going to try to boil what is a very complicated topic, right, down into 4 summarized sections. Okay, so the first is going to be identifying who the chief operating decision maker is at the company. The second is going to be what are your operating segments. The third's going to be, are those operating segments reportable segments? And then the last item is going to be, once you've identified what the reportable segments are, what disclosures do you need to build around them?
So let's get started with the first one, the
Sure.
chief operating decision maker.
Yep.
How do we determine who that is? I'm guessing it's not an official title.
Yeah, so like a lot of things in FASB, it's not black and white, right? It requires a lot of judgment, and it requires a little bit of an introspective look at your company, and it requires you to think about who at the company is responsible for measuring the financial performance of the company and for the allocation of resources throughout the company. Usually this person's in a high level, so you're thinking CEO, CFO, someone with obvious decision-making power. But you can also keep in mind there may be an executive committee, there may be a management committee that collectively reviews financial information and makes decisions on the allocation of resources. So step one is identifying who that individual is. If it's the CFO, great, it's the CFO. If there's an executive committee that manages and monitors financial performance, great, maybe it's the executive committee. But you have to go through that analysis, and you have to look at the details within the standard about the identification of who the chief operating decision maker is, which in the standard is referred to as the CODM, and you've got to document your analysis of how you came to that conclusion.
And I'm guessing that if that changes, that needs to be documented as well, because very seldom do things change December 31st of any year,
Right.
So you want to make sure you're keeping that up to date as you go along too.
Right. Now, previous to the implementation of the standard, the identification and disclosure of the chief operating decision maker was not part of the codification. It wasn't something that you had to do. So for most entities, it may be in internal documentation. Considering the fact that, we talked about earlier, the original standard was issued in 97. Now we fast forward to now, this is 2024. My guess is most companies out there are not on an annual basis renewing their assessment of who that CODM is just to come to the conclusion that we don't have any reportable segments. So I think for a lot of companies, even though it's been out there, this is going to be a new exercise, and the person that they identify is going to be newly identified.
So it's a great opportunity for them to take that time and determine that. And
That's right.
Good starting point for it.
That's right.
Okay, so Ian, let's move on to the second point there. And I think you had mentioned that it's identifying operating segments.
That's right.
So what's changing within there?
Yeah. So again, we're going to go back to this concept that it's not a black and white decision, right?
Seems to be common there.
It's FASB loves this. They love judgment. They love gray. So and the reason this becomes difficult is because it depends on really what your organization does to measure financial performance. And all organizations are different. We work with a lot of banks, with a lot of financial institutions. That's my area of expertise. And I go from bank to bank to bank. I look at reports that are presented to the board of directors across the industry. They're different. They're looking at different metrics. They're looking at different perspectives of the business. The business itself might be different. For example, let's say you have a consolidated financial institution that has a banking subsidiary and it has a trust and wealth management subsidiary. My hunch or my initial thought would be that you're probably monitoring the performance of those two components of your business separately, right? And so if that's the case, whether it's a product line or a geography, they would be operating segments. A good way to maybe start to frame this out or build an analysis of this would be, let's say you identify the chief executive officer as your CODM. And if you look at your organizational chart, underneath the chief executive officer is the chief lending officer and the chief investment officer. Well, if those two departments are reporting separate discrete financial information up to the CODM, and they're using that separate discrete information to make decisions on allocation of resources, you've pretty much identified two separate operating segments. But it's not always that clear. And so it really takes an introspective look at your business and an analysis of your operations to identify what those are.
So all of that makes sense. But how is an entity supposed to actually determine whether or not they have the segment?
Right.
Do you have any guidance for them?
Yeah, you could start by asking yourself three primary questions. Does the component have activities that it derives revenues and expenses from? Do the activities of that component get reported to the chief operating decision maker? And is there discrete financial information available for each of those component activities? And if that's the case, and you can answer yes to all those questions, you have an operating segment.
And that was going to be my follow-up question. Do you have to answer yes to all of them? So if you answer no at some point,
that's right.
You're out then. You're a no then.
Yes. I say all this with the overarching caveat that this is extraordinarily complicated, and these are kind of high-level guidelines. You'd want to go in and make sure you do a thorough analysis of those considerations.
And talk with your auditors.
That's right.
So now let's move on to step 3, identifying if they are reportable segments.
Yep, that's right. So you've gone through your analysis. At this point, you know who the CODM is. You know if you have operating segments. Now you have to step back and say, are any of these reportable segments? And that analysis is a little more straightforward. It's really a quantitative measurement of the information in those operating segments to identify, are these reportable? Do I have to worry about these and report them individually? Or if they're insignificant, can I sort of aggregate them together and report them as either one reportable segment or as a category within reportable segments called other, right?
Lots of options.
Lots of options. You may come to the conclusion that you only have one reportable business segment, right? And that is certainly possible. If you look at the amount of filers that are out there, in particular community-based financial institutions, you're not going to see a whole lot of detailed reportable segment disclosures currently. That doesn't mean they don't exist. That just means that maybe when these assessments were done years ago, their conclusion was we only have one reportable business segment. That's still also a possibility, and we'll get to the disclosures around that conclusion later, but you go through the reportable segment identification to know whether you have one or you have multiple reportable segments.
So Ian, do you have any questions that they can kind of go through to determine how they should answer?
Yeah. So generally, this is going to be a quantitative test, okay? And it's based on whether or not revenues, profit or loss, or assets are greater than or equal to 10% of the combined or consolidated information for that group, okay? So you would first, let's take revenue. You would take, measure the revenue of that reportable segment, and you would compare it to the total revenue of the combined reportable segments, and you would identify whether it's greater than or equal to 10%. You would do the same exercise with assets, and then you would take profit and loss. And that gets a little tricky because you may have some segments that are in a profit position and some that are in a loss position. And generally, you're looking at 10%, whether it's greater than or equal to 10% of the total segments that report profit and the total segments that report loss. Again, it's complicated, but that'll give you a real good starting point to go in and do your evaluation for the quantitative measurement.
So it sounds like 10% is kind of the magic number.
Yeah, seems to be in this case.
Is this section in these 3 tests, do they have just as much judgment and just as much uncertainty as the other sections?
Well, anytime you're incorporating a quantitative element, it gets a little bit more straightforward. But like I said, it's nuanced and complex. So there is certainly a lot of guidance around those 3 tests that everyone is going to need to understand and consider when they're doing those assessments.
That
Absolutely.
Makes sense. I didn't think it could be as simple as you just sit down and answer yes or no and move on.
Nothing is that easy. If it was that easy, I would be out of a job.
Okay. So are we ready to move on to the 4th part of that initial list you gave us, which is about the disclosures?
Yeah, and what's interesting here is the 3 steps we've kind of already talked about have already been in existence since the original standard was put into place. So we're really just recapping something that's already been there. This is the spot where we talk about what's new.
So the fact that it hasn't really changed up to this point, it's just that there's a little more expectation now that it's actually, they're giving guidance on how to disclose this on an annual basis.
Yeah, that's a good point, and one that's I think worthy of pointing out that the SEC's perspective on this topic is that companies underreport reportable segments in general. So as you go through your analysis, just saying we didn't have one before or the bank next door doesn't have one doesn't mean that it's not a good time to re-justify that conclusion.
And by having it in the disclosures, then it sounds like it's an annual process. So they're saying we want you to look at this more regularly and give it the attention we think it needs.
That's right. And not only that, but even if you conclude the same thing you concluded before, which is that we have one reportable segment, now we still go to the disclosure part of the standard and we have to implement those items.
document it all along and everything else.
That's right. Yep.
So what's all included in the disclosure then?
So, yeah, great question. On the disclosure items, let's kind of put it into three general buckets, okay? You have your general disclosure topics, you have information on profit, loss, and assets, and then you have the reconciliation, okay? So the general topic is going to be fairly straightforward. One, FASB would like for you to disclose the information to identify how you arrived at what your reportable segments are, sort of the details of the things we had talked about previously. In a narrative discussion, you would identify who the chief operating decision maker is, including their title and their position, and then you would describe the nature of the activities that comprise each of those reportable segments.
That sounds rather straightforward, but I'm guessing that there's so much of the work that has gone into it up till that point.
Yeah, and there's some subjectivity in, what's significant and what's not.
So Ian, can you tell us and give us some guidance on the part about the information on profits and losses?
Sure. So think about where we are now. We've identified our reportable segments, and we've disclosed general information about our analysis and the CODM. So now you take those reportable segments, and you are supposed to disclose information that the CODM uses in their internal analysis of the profit and loss of each of those reportable segments. Understandably, there may be internal profit and loss measurements that are closely related to the GAAP financial statement measures. There may be some that are a little further, non-GAAP measurements from the GAAP-related financial measures. So you should first identify which of those profit and loss measurements most closely align with the directly comparable GAAP measure, right? And that would be the one sort of your default option, so to speak. There is some subjectivity in there and the opportunity to disclose multiple, and you would want to consult the guidance for how to make that determination. So you determine what the measurements of profit and loss are, and also the measurement of assets related to each of those segments, and you would disclose that in a tabular format that would then kind of foot over to the combined or consolidated total for each of the segments.
Everything has to tie together.
Right, and we'll get to that in a minute. When you're thinking about the profit and loss disclosures, and again, kind of bring this into the context of a bank. Let's say, for example, you identify your investment operations as a reportable segment. And the way that you monitor the performance of the investment reportable segment internally is to look at the net interest income on that portfolio. So you've got the interest income generated by the segment. You've got the interest cost possibly associated with leveraged borrowings that fund those investments. And then you've got the net interest income that's reported from that segment. That may be an internal profit and loss measurement that is really directly comparable to the most closely correlated GAAP measurement. I'm not saying that's necessarily a measurement of profit and loss, but that could be an example of the conclusion that you might come to. So you go through that analysis and you make those conclusions, and then you disclose what those measurements are. And then you provide a qualitative description of how you're evaluating the information that you've presented above.
These sound like they're going to be pretty lengthy overall then.
It depends, as with many things. It might be lengthy. It might not. Let's say you conclude that you have one reportable business segment. The default option in that case would just be to say our net income is the most significant component of profit and loss that we evaluate. And so you're really just tying it in directly to the financial performance result that is already being reported in your income statement.
Okay. So are we good to move on now to the third part, which I believe you said was reconciliations?
Yep.
How does that tie into this?
So let's go back to our example, okay? So you have a segment where you're reporting net interest income, okay? Well, there are obviously other expenses of the business, possibly related to that reportable segment or possibly related to the consolidated entity, that you would need to factor in there in order to reconcile from net interest income back down to the net income reported on your income statement. So the reconciliation is a series of items that you would have to disclose to allow a user of the financials to get from your reported financial measure back down to the consolidated operating results that are presented on your income statement. And that's boiling a lot of information down into a pretty condensed explanation, but that's the idea, is reconciling the measure back to the financials.
So overall, it sounds like there's a lot of judgment involved throughout the entire process. It sounds like really good record keeping needs to happen as well, too, to ensure that by the time it comes to disclose everything, that they're ready for that. What else do clients need to be aware of?
Well, I would get started now. If you haven't started your assessment yet, I would certainly do that as soon as possible, because there is going to be some legwork just in doing the analysis to begin with to identify reportable segments. What we always encourage our clients to do, especially if you're an SEC reporting company, is to prepare what I would call an accounting standard adoption memo. And in that memo, you can actually identify a lot of the things we talked about. So, for example, you may start with identification of the CODM, and then you would document the steps that you went through, and you document your conclusion. Go to step number 2. What step did you go through? What's your conclusion? So as you go through the process, you're building auditable documentation that you can then provide to your audit firm and say, here are the steps we went through. Here's the support that supports all the analysis, and everything's in one package. You don't have to sort of pull different parts from different places to produce it for your audit firm. So that would be my best recommendation at this point.
And that sounds like you'd really be set up for future years, too, of just kind of rolling that forward, making sure you still go through it, but you have that shell built then of
Absolutely.
This is how we go through and do it.
You would use that same approach anytime there's a new standard that's going to affect your company. Or to be honest, anytime there's a significant or unusual business transaction that maybe you haven't entered into before that has unique accounting guidance around it, we would always encourage our clients to go through and do that type of analysis and memorandum.
Ian, can you mention the time frame again? I want to make sure that I'm clear on that and that all of our viewers are as well.
Sure. Well, the standard's effective for this reporting season. So for a calendar year entity, if you're a publicly traded company that files with the SEC, your financial statements are going to be due sometime in March, largely. So the analysis would have to be completed, the disclosures would have to be made, they would have had to be audited by that point. So working backwards, starting, I would say, as early as possible, and so you can build your assessment, have time to provide it to your auditors and support what you've done and build your disclosures would be my recommendation. The other thing to keep in mind is it's not a one-time thing. On an annual basis, you're going to have to reevaluate this and make sure that your conclusions are still relevant and build these performance metrics and analysis for each of the reportable segments. So it's an ongoing part of your business process from this point forward.
Thank you for clarifying that. It was great to have you back on the podcast today, and I'm sure that so many of our clients are going to appreciate this detailed information that you provided as well. Thanks for joining me once again, and I'm sure if anyone has any further questions, they can reach out to you on LinkedIn or just reach out in general too.
Yeah, thanks, Lenore. It was fun.
Thanks for watching our podcast today. If you'd like to learn more about our firm and our specific areas of expertise, like and subscribe below. You can also visit us on our website at srsnodgrass.com.